Hello, welcome to Economics 101, your number one source for everything economics. Banks are making billions right now. Profits are strong, balance sheets look solid, and on paper everything does seem fine. So why are investors getting a little bit nervous? It's because when you take a closer look, these profits might not mean what you think they mean. In today's video, we're going to break down three specific topics as they relate to banks and our banking system. The first thing we're going to talk about are why are banks so profitable, especially in 2026? What risks are building beneath the surface? And number three, why investors are starting to pay close attention. Before we jump into the video, I have a quick favor to ask that really helps grow the channel. If you find this content helpful, consider liking the video and subscribing. It helps more people see these breakdowns and just, helps the channel get out there. So let's go ahead and jump into things. Let's start with the obvious question. Why are banks making so much money? It comes down to pretty much one key factor, okay? Interest rates. I talked about interest rates in my previous videos. I'm going to have a lot more coming on interest rates because they are such an important part of our economy. But when it comes down to why banks make profit, it's interest rates. Banks make more money on the spread between what they pay you, which is called the deposit rate, and what they charge borrowers, loan rates. And right now the spread is wide. For example, savings accounts might pay around 3 to 4%. Credit cards and loans can charge anywhere from 7 to 20% plus, okay? That gap is pure profit margin, all right? This is called net interest margin, and in high rate environments, it expands significantly. So yes, banks are thriving, but that's only part of the story. We got to go a little bit deeper into how and why they're making so much money. Okay, here's where things get a little bit interesting. So how interest rates boost profits, but they can create problems later. All right. So what kind of problems, or why are problems created when you have high rates now, which profits are going up? It's because expensive borrowing slows the economy down, okay? Think about it. When you have high rates, mortgages become less affordable, businesses take fewer loans, and consumers cut back on their spending. So while banks earn more per loan, there are fewer safe borrowers over time. It's like, squeezing more juice out of, or trying to squeeze more juice out of a few oranges. Eventually that becomes a problem. All right. So investors they're hidden risks associated in all of this. And this is what investors are really watching. There are three major risks that are building up right now. And most investors kind of have their eye out on these three risks. So we're going to start off talking about loan defaults. Okay. As rates stay high, more borrowers struggle to keep up. Credit card delinquencies have been trending higher, especially among lower income households. Second one, commercial real estate. Office buildings are still under pressure post-pandemic. High rates plus low occupancy equals declining property values. And banks hold a lot of that debt. And the last one, unrealized losses. Banks bought bonds when rates were really, really low, okay? Now that those rates are higher, those bonds are worth less. They don't have to realize these losses immediately, but the risk is still there. It doesn't mean it goes anywhere. Okay? Quick pause, guys. If you want more breakdowns like this that simplify what's really happening in the economy, make sure to subscribe and stick around. I have a lot more videos that I will be putting out, and I really would like to grow the channel. So please subscribe, like, leave a comment. Now let's hop back into it. So let's talk a little bit about the Federal Reserve and their role in all of this. So the Federal Reserve, they play a huge role in everything we do, okay? As of 2026, rates have remained relatively elevated compared to your mid-2000s, okay? The Fed's goal, one of the Fed's goal, of course, is to control inflation. But here's the trade-off. High rates fight inflation. That's how you fight inflation. If we got inflation, the Fed wants to raise rates. but they also increase financial stress. Higher rates slows growth down, okay? So the Fed can find itself in a tough spot. So a big question, will the Fed keep rates higher longer, or will something break first, right? Because historically, when financial stress builds, something eventually gives. That's usually how it works. And we kind of been sticking around to figure out what's exactly going to give. And banks are usually at the center of all of that, okay? So now we're going to move over into the core question. Why aren't investors celebrating these huge profits that the banks are giving or getting? It's because markets are forward-looking for the most part. They're not focused on today's earnings. They're focused on tomorrow's risk. And right now, the risks include rising defaults, slowing economic growth, potential stress in financial markets. So even though banks are making billions today, investors are asking, investors are still asking, is this sustainable? Okay? How long do we keep this up? Something will eventually crash. But who knows when? All right? If the economy weakens, bank profits, they can disappear quickly, right? So the big takeaway of everything, strong bank profits don't always mean a strong financial system, bottom line. The simplest way I can kind of put it. In fact, sometimes they're often a warning sign, a sign that rates probably are too high, a sign that some type of pressure is building within the financial system, and the system may be being tested. You know what I'm? For you and me, pretty much this means staying aware of where we are in our next financial or economic cycle. Because what looks strong on the surface can really be fragile when you kind of start peeling back layers. Underneath, it can be really fragile, okay? So I want everybody to continue to pay attention. If you found this breakdown helpful, please like the video, subscribe to the channel, and drop a comment. Do you think banks are safe right now, or do you think possibly in maybe 2027 or maybe even later on this year, we're going to have a lot of banks that crash? Again, this is Evanomics, your #1 source for everything econ. I appreciate you watching today. Thank you, and I'll see you on the next one.